That's always the loudest thing ever. Well, how is everybody? Still stuck in the house?
Always.
Always. Always is unfortunate. I'm still driving 100 miles a day. I don't know why you guys are just sort of stuck there. I decided that I'm essential. I've got to get my work done. There's probably a whole lot of people that hate me for it, but oh well. All right, so today we're going to talk about cash flow statements. It won't take the whole class, so it's kind of the bonus today. Is the PowerPoint visible to you?
Yes.
Thank you. So this is the third of the three important financial statements that businesses use to manage. The first was the income statement that lets us know how well the business is doing. Basically, it's scorecard, figuring out, is it making money or is it losing money? The balance sheet is the tool that tells you, at least in book value, what a company is worth. In reality, a company is worth the difference between its assets and its liabilities, plus some multiple of its net income. But it's not uncommon for people to consider the balance sheet what a company is worth. And the reason we talk about it that way is because it has that owner's equity section associated with it. So when we remember that the assets equals the liabilities plus the owner equity, if we sell all the assets and pay off all the debts, the money that's left is attributed to the owners. This third report is really one that helps in medium to longer term planning. So we're looking at all the money coming in and all the money going out, and adding the opportunity of, borrowing money or allowing new money to come in the form of new investors. And that's the money that allows businesses to see, will they need to borrow or can they invest? So when their cash flow is strong, as in they're taking more money in than they're giving out, at some point they've got all sorts of available cash and they decide, should we give that to the owners as in dividends, or should we reinvest in the business to try to increase the amount of business that is possible? And so a cash flow statement is looking at all of those sources of money, all of those needs for money, and a section on, where to get more money or what to do with money if you have extra. So in the cash flow report, we're looking at all the cash going in and out during a specific time period. So as we spoke about an income statement, which is a month, a quarter, a year, what did we do? Did we make money? And a balance sheet is what are we worth right now, a point in time. The cash flow statement is, again, a monthly, quarterly, or annual tool that allows, let's say, the chief financial officer, the executive team, to see that their plans are going to need more money or is going to generate enough money to decide what to do with it. It's just a picture without truly defining the day-to-day activities that generate cash. But in the aggregate, are we going to have enough money to keep this business going? And if so, then everything stays the same in your plan. If not, then you have to decide whether you need to borrow money or raise additional capital through, selling stocks in order to go ahead and proceed with the plans that otherwise there might not have been enough cash for. Cash flow statements are looking at how effectively we use the cash to finance its activities, pay its bills. So a company that generates a lot of net income may choose to save money in order to buy a new piece of equipment, or may choose to borrow money to get a new piece of equipment, or may, in the third case, choose to lease a piece of equipment, something they do not own but have the benefit of access to. Each of those ultimately is a decision the company will have to make. And so if it's beneficial to have that new piece of equipment sooner, then it may be quite reasonable to lease or borrow to get it. If they don't need it today, they might forego the extra expense of borrowing or leasing, which is the interest that you have to pay, by saving the money and buying that piece of equipment when the cash is sufficient to do so. So the cash flow reports, we're really looking at all the things that have generated cash, operating income, as in the money, the net earnings from our profit and loss statement, and perhaps interest that was earned on money that we had in a bank account. Perhaps it is rent from a property that we are leasing to somebody. Perhaps it is something that we sold that still had some monetary value. So there are lots of ways that activities generate cash. Of course, with an operating income, you could be talking about operating losses, so that it isn't always a positive flow of money in a cash flow report, but it is something that has happened as a result of our profit generating, hopefully, activities. We also look at, in the cash flow report, what activities use cash. Did we purchase that equipment? Did we pay interest on our loans? Generally speaking, the day-to-day bill paying, payroll, taxes, etc., is embedded in the operating income. So you just see that net money in on a cash flow report on operating income, not activities that in the cash flow we're not seeing each of those line items, purchases and payroll and etc., because it's already embedded in that top item. things that may have used cash could be the purchase of a new business, purchase of a new product line, things of that nature, development of a new product, so research and development. Those are things that a business would assess, budget for, and decide where that cash is coming from, whether they are taking it from income or whether they are borrowing or selling stock to generate that money. So these activities that are going on are used to forecast how much cash a business needs. It's not uncommon for, a business in the first quarter of their year or the last quarter of their year to decide what big goals they have. They would like to double their output, or they would like to develop a new product, or they would like to purchase a new building. So they have these goals associated with the business to improve it. And they're using cash flow reports to tell us, can we afford it without borrowing money? Do we have to borrow money? Can we sell shares of the business and get new investors? How will we do those things that as a business we know are a good thing to do? So the cash flow report is used to help guide the management team, the financial team, through what could otherwise be problematic. If you decided, well, I'm going to spend $100,000 on new equipment so that I don't have to pay taxes, maybe that's not the best plan. I've seen companies do just that and then find themselves in financial peril because the $100,000 less tax would have given them, $70,000 to manage their business with, but because they committed it to equipment, they didn't have anything that would help them through a troubled time. So once again, sources of cash that are coming into your system: net income or loss from operations. So if you're in production, that's you're selling goods, you're taking away the cost of goods sold, taking away the selling general administrative, all those items on an income statement. And whatever that bottom line is, whatever your net income or loss is, that ends up being money coming in or not to your cash flow equation. If you sold a piece of equipment, sold a building, sold some intellectual property, there's all sorts of things that you could sell. You are trading that item and what that item might benefit you for cash. So you might have a one-time influx of money from selling a building, but you no longer have that building to use. So that's a source of cash in. You may decide to borrow some money. So right now, if you were to pay attention to what's going on in the US, there's an awful lot of discussion about CARES Act, payroll protection programs, SBA lending at very low numbers, just so that businesses can get by these 6 to 12 weeks of pretty terrible business, at least a pretty terrible business environment. So a company might say, I need to borrow some money in order to get through a time where I really expect to have a loss in operations so that I can get back to good financial health when the situation resolves itself. So a company taking in new loans, uh, a company purchasing a new piece of equipment, a new building. These are all types of loans and types of longer-term debt that businesses take in. Most of them are a function of increasing their net income because they're increasing their capability and capacity. But in the case right now, while there is a lot of pain in the world, it depends a little bit on how you approach it. For me, I decided that I'm just going to keep going. And it hasn't been a bad idea. I continue to get a lot of new orders. And I suspect that some of my competitors who are in worse states may not make it through because they've been told they cannot, in fact, go to work. I'm unfortunately or fortunately an optimist, so I expect 3 months of crap followed by a period of growth. And so far, I think that's still a very likely scenario. Another way a company will bring cash in is by selling stock. Let's say you have 3 partners and you know that there's a good opportunity for you to purchase another product line or purchase another building. But between you and your partners, you don't have enough money to take the action you know that will help you and grow your business. So you may choose to sell some stock to somebody, and now you have 4 partners. They're bringing in new money into the organization, allows this transaction, this plan to go forward. So that's cash in that you don't have to pay back. They just now have a bit of, you dilute your ownership a little bit, but you share in it in a good way. So those are sources of cash coming in. Of course, we definitely have ways that cash leaves us. And again, on the cash flow statement, by and large, we're talking outside of day-to-day operations. So the net income, the income statement is showing you all of your day-to-day transactions. But in the cash flow statement, we're only seeing that bottom line. And so uses of cash that happen to be available, you could consider paying your owners a dividend. So if there's excess cash and you don't have a good thing to do with it to generate even higher sales or higher profit, taking that cash and sharing it with the owners increases their net worth because by and large they invested in your business in order to make money. And sometimes it comes in the form of dividends, cash paid out. Sometimes it's in the form of increasing value. So companies will go through both. They will either increase their value by purchasing that new product or that new building or that new company. And sometimes they will say, we don't have anything worth spending the money on. So you as owners are going to benefit and decide what you would spend your portion of our excess cash on. Cash, of course, we may choose to purchase new assets, new equipment. And in this way, we aren't talking about borrowing money to do it. We're talking about using the money that we have within the company that we don't have a better use of for, or we could use it for many things, but we believe in doing so, we're going to increase the revenue, either increase sales or increase the profitability of those sales by spending this money. So we're buying something today for the benefit tomorrow when we talk about purchasing fixed assets. You can also look at using cash to pay down debt. If we owed $100,000 and all of the interest that is associated with that, by paying, $25,000 or $30,000 of that, we end up having less interest to pay, so we reduce our operating costs. We basically trade asset and liability, and therefore our owner's equity has the opportunity to go up. Sometimes businesses, when they have a lot of shareholders, sometimes businesses choose to purchase back shares of stock that individuals own. In doing so, the person who sells you the stock takes their portion of their investment out, but the shares come back into the corporate ownership and increases the share value of everyone who remains as an investor. So stock repurchases kind of has a similar effect to paying dividends in that it's increasing the value of an investor's investment, but it's a different approach to it. When you look on a company's balance sheet, you will see, like treasury stock, how much stock did the company buy back? That's different than the issued or unissued stock, because a treasury stock is stock that was purchased back, so it's been issued, but now it's owned by the remaining investors within the company instead of by an individual. So it's another way that we can increase the value of a business to its owners. Fewer owners, fewer outstanding shares, the same value now is spread against a smaller group of people. When we look at a cash flow statement, you'll see it most of the time as operating activities, investing activities, and financing activities. Operating activities are from the net income, the income statement, the profit and loss statement, from that tool. And what you see is there's a line item that says add depreciation expense. So depreciation is a non-cash transaction that reduces your taxable income. Depreciation is the ability or the way that businesses who have invested money in buildings, equipment, etc., where they are expected to last for many years, the depreciation of that $10,000 car, for example, instead of taking all of the expense right when you buy it and then having a $10,000 expense on your income statement and perhaps showing that as negative income that year, if you take that $10,000 and split it up into 7 years, each year 1/7 of that $10,000 is deducted as depreciation expense, and that has the impact of reducing your taxable income by that much. So effectively, you are paying less tax as a result of depreciating assets. In the form of investing activities, the company may choose to purchase equipment, sell equipment, purchase land, purchase a building, sell a building, any of those kinds of things where the expense, if it were to, when it goes on the income statement, really just shows up as depreciation expense. And on the balance sheet, it shows up as an asset and probably a liability if they borrowed money for it, or it shows up as an asset and an increase in the owner's equity if they didn't borrow money for it. But these are the expectations. This coming year, we plan on spending $50,000 on new equipment. We need a new truck for another $20,000. So we're going to have to find a way to pay this $70,000. And we can do that through borrowing. We can do that through the cash flow that we expect. We can do that through the cash we have on hand instead of giving it back to investors. Those are all decisions that a business will make. But this investing activity are places where on a cash flow statement, we're targeting those specific types of transactions because they are outside of our operating expectations day in and day out. So in this case, they purchased $1,000 of equipment, but we sold something for $500. So this particular statement shows that we better find $500 or $500,000, as the case may be here, in money through either borrowed or new investment in the company or from the operating income. Finally, in the cash flow statement, you have the financing activities. Maybe we borrowed some more money. There was already some borrowed, so you have an increase in debt. Maybe you sold some new stocks that brought some money in. Maybe you paid out dividends. These are all things that happen relative to the organization and how it generates money outside of just this operating income or loss. So you can see that for this particular statement, there is a positive change in cash flow. So we have 1,400 and what? I think those are thousands. 1.4 million, whatever it turns out to be, in increased cash coming into the organization in this time period, though I don't know what that time period was on this particular example. When you look at a more complicated cash flow statement, so you can see Apple, it's an older version, but it'll give you an idea. They had cash in the bank. You can see quite a lot of cash, $10 billion of cash at their end of their fiscal year in 2013. And they expected 37 billion in income, different charges for depreciation, different payments, vendors, etc. All the cash generated by the operating activities at $53.6 billion. Then things that they do for investing, so that they purchased other companies. They say purchase of marketable securities. Apple has a tendency to buy little companies that they think will perform well or fit well in their business model. They're developing a product that they would like to market later on. So purchasing of marketable securities is frequently purchasing a company or companies. And then some of their securities might be bonds, so they lent people money, and so they're getting money back when those bonds are paid back with interest. So these are the kinds of things that they might do from an investing standpoint. You can see that they planned on spending $33 billion that particular year, or did spend $33 billion that particular year. And they had that 53 coming in and 33 going out. Then you notice they have different financing activities. Sometimes they borrowed money, sometimes they issued stock. In this case, it doesn't look like they borrowed any money, but rather mostly, $500 million from selling stock, tax benefits that they've had, taxes they've paid. So the different line items on their much busier cash flow statement define what's going on with this organization. In the end, at the end of the year, they clearly show that they have, $14 billion in the positive. They're okay relative to their plans and their available cash and programs that they've got in place. So they're using the cash flow statement as a tool to see, do they need to borrow money? Do they need to sell stock? Or can they in fact invest in other companies at the moment? So they're using that tool to help them make those kinds of decisions. So when we talk about a cash flow statement, we've identified a bunch of different items. So we know, for example, accounts receivable is on a balance sheet and it's cash coming in. So we'll consider that from operations. So that's operating activity on the top section of our cash flow statement. We know that purchasing equipment fell into that investing activities, same as purchasing a new building. So those are items that would show up in a financing activity, something that we've decided we're going to have to pay for. And when you look at those are investing activities. And what we look for in the third section of financing, you've got the sale of the stocks and things of that nature, where these are a source of money that we'll have access to. I don't have any polls today, and I don't have much more on this topic. So if there are any questions, go ahead and ask them, and we'll.
Professor?
Yeah.
I had a quick question about companies buying back their own stock.
Mm-hmm.
What if they had excess funds and they wanted to buy back some of their own stock, but none of their shareholders wanted to sell their stock?
Then they can't do it. I mean,
okay. So they're just out of luck?
Yeah, there's no requirement for a shareholder to sell anything they own. So effectively, what you'll see in those cases, a company may decide they really want to buy back some of that stock, and they simply didn't offer enough for it. Remember, we are in a what will they bid? What is somebody going to ask? What would somebody accept to sell their shares? So that's mostly a function of, hey, I'd like to buy back my stock at $1 a share. Would you sell it to me? Heck no, it's worth $10 a share. So that company might offer more per share and actually get somebody to buy it back. But it is a market value transaction.
Okay. So they can't produce more stock and say, all right, we actually have this much stock now?
Well, most companies have stock available, issued stock and unissued stock, right? So the overall number of shares are established when they establish the business. The amount of shares, the number of shares that they've issued are the ones that were sold. The company can go ahead and issue more shares, but it ends up reducing the value of the existing shares because now that business is spread out over more people than it started out to be. Technically, it shouldn't reduce it, but on an individual basis, the money that when we sell more shares, we bring in cash, that's the asset side, and we give out equity in the form of additional shareholders. So it should balance, but frequently people look at that and go, well, now if that money coming in didn't change dramatically the net income of the business, then the income is spread thinner over more shareholders. So it's not uncommon, I think, when people sell more shares, they do generate some cash, but it starts to dilute the value of everybody's individual shares and it starts to reduce in the market, even though there's that balancing transaction on day one.
Okay, that makes sense. Thank you.
Mm-hmm.
So in that case, you can just hold on to a controlling interest worth of unissued stock, and then everybody else just like, hey, your vote's nice and all, but thanks for the money. I'm going to do what I want.
No, not when you phrase it that way. If it's unissued stock, nobody owns it. It doesn't become part of the voting pool. If you, however, own a controlling interest, then yes, you can do that. So in a situation where you own 51% of a business, you pretty much dictate what its actions are going to be. That doesn't mean, however, like let's say you own 48% of the business, that doesn't mean the other 52% of ownership can't come together and go, nope, not going to happen that way, Rob. We're going to do something different. We understand you are the single largest shareholder, but you do not have a controlling interest. The shares that have not been sold, have not been issued, and that are owned by the company doesn't supplant the rights of the shareholders who have invested in it.
All right, so you do have to issue that stock if you're going to use that in order to stave off or in order to maintain control.
Correct. Well, to maintain control, selling stock that's in the treasury, if you were to sell it to somebody who is sympathetic to your point of view, then they become somebody who votes with you. And in that regard, I suppose you could retain control over it, but that's tentative at best. Because if that person who votes with you at first finds out, for example, that all the other shareholders had it right and you had it wrong, you've got no more leverage at that point.
But can you sell it to yourself? For example, like basically you sell it to yourself in order to maintain, like you keep that as a backup and then sell it to yourself just in case you make a mistake and somebody else starts to get closer to a controlling interest.
I mean, you can invest more money and therefore gain more shares and do it that way, but it isn't something that, I think I'll just write myself another 100,000 shares to increase my interest. That's not going to be legal, but you can certainly be the person purchasing additional shares. If you are truly putting money into the business and trade for what is effectively the market value of those shares, I mean, you can't sell it to yourself at 50 cents on a dollar what other people would pay for it, that's for sure. But you can buy more shares if the company and all of the, investors decide, yes, we do want to generate some additional capital through selling shares, then yes, you can certainly do that. But it would be at the same value per share as everybody else's. You don't get to manipulate that market.
No, that I do understand. I was just trying to make sure you basically issue yourself or buy the unissued stock to recontrol the company.
Yeah. Any other questions?
I've got one about the current mess.
The current mess, go ahead.
How long do you see this lasting? Just an estimate, seeing as that you've probably seen this happen once or twice.
No, nobody's seen this before, but I think it depends more on the people of the world and how they react to it than anything else. So there are people out there that are talking about, we'll talk about a global recession, and that is most certainly a possibility. I think the old saying was, if the United States catches a cold, the world catches a flu. Well, we got more than a cold, but it's a shorter term, at least for all purposes that I can identify right now. If I watch what's going on, it's an event, not a trend. Like, we don't expect to never recover from this. We expect this to become part of the woodwork. If you look at how we've responded to other pandemics, this is a unique response. And so this one has put people home in huge numbers, whether it should have or shouldn't have. People will be deciding that for years to come. But when people get a chance to go back to work, these are the things that will restart it. Is it going to be I think people are talking about a U-shaped recovery as opposed to a V-shaped recovery. Someone mentioned a W. We're going to go down, come back up, and then, people will get sick again for a little while, but will respond differently. They'll come back down and go back up. Honestly, it dropped 30%. It came back up 10%. It dropped further than I expected when you think in terms of the stock market. The corporate earnings are definitely taking a hit. But I also know that for the most part, I don't see people going, okay, I'm dead. I'm just not going to try anymore. That's not what I expect in the world. And that's what it would take for it to be a terrible situation.
Do you see much of a correction? Because I've been watching some of the business, and it seems like a lot of the unsustainable business practices are getting unmasked. Somebody kind of pulled the rug up and looked around and went, "Ooh."
Well, what kinds of things would you identify as an unsustainable business practice?
I've seen a lot of the media running into a lot of trouble. Like, there are a lot of the online businesses and internet-based businesses that are facing a significant amount of trouble.
Well, that's a function of, I think, people's cash and what they're worried about, which is primary. If you've got consumer confidence in the crapper, then you certainly are not going to jump back up. But what you'll find is the habits that people have had will probably take hold if they get a job back in the next 15 to 45 days, depending on where in the country you are. Then a lot of them will have weathered the storm. Will they save a little bit more than they had been? Yeah, probably. They'll probably go through and say, I didn't expect that. I think I'm going to maybe curtail a little bit of my spending and turn it into savings. But we've grown accustomed to going out to restaurants. We've grown accustomed to going on vacations. And the odds of that going away are pretty low. The companies that are going to be in bigger trouble are probably the ones that were top heavy. So my personal opinion is that if you think about a school like ASU and you see just how many people are employed by ASU that are not doing this with you, and you see how much they've invested in infrastructure in terms of the buildings and that kind of stuff, that I see that some of that is definitely at risk and going to have to change. So that I absolutely have no insight, but if I were to guess, they're going to peel back quite a layer of administrators and staff within a university, for example, in order to be there when the cash flow ticks back up, because it's really difficult to get rid of big ass buildings. And when I look at businesses, some of them have shed employees. Some of them were commanded to shed employees. If you assume a restaurant comes back in play, will they be able to have as many people in the restaurant as they did yesterday? Probably not. So their business models will have to change, but that doesn't make what they were doing wrong. I would say one of the things I would anticipate changing is some of the businesses that left the US to go overseas will at least have some more redundancy than we did right now. If we are that dependent on overseas manufacturers for, I don't know, the medicines we use, it's kind of a problem. You look at what Medtronic did. Medtronic offered their technology to anybody that wanted to build ventilators. You look at what businesses have done to change what they make to support the country relative to, I don't know, a mask, for example. There are businesses in town that changed their production to make face shields, and they did this like that. So I see there are a whole bunch of new businesses that will probably have popped up in the midst of this, and they probably won't fall out of favor because we as a community will probably end up supporting them. Definitely companies that ran on the edge and weren't using their cash flow predictions. They're waiting for tomorrow's customer to pay them in order to pay their employees. There's a whole bunch of businesses that had no capability of surviving a shutdown for 2 weeks, let alone 6 to 12. And nobody really plans for that. In your personal life, you probably plan for 6 months being out of work once you get the chance to put some money away. But in business life, that's a big nut. If you're running 10 or 20 people in your organization as a small business, that's an awful lot of payroll and payroll taxes to be able to just have in your back pocket. So that is probably unrealistic. I know I have one out of my 10 employees or so that has decided to stay home. So we're having to fight through the fact that we have less capacity to do the work that we have and are getting. And I'm getting jobs every other day, not small ones either. So I'm going to be faced with having to bring somebody in probably in 2 weeks, which is weird. But I guess that's a good problem to have.
Do you foresee any changes to the regulatory environment, or is that just such an opaque system that there's no real way to tell?
Well, the current administration has reduced the regulations significantly over the past 3.5 years and dramatically in the past 3.5 weeks relative to things specific to drug testing, trials, your ability to get things that otherwise you couldn't get before. So I think that it's going to happen in the deregulation standpoint, not the added regulation standpoint. When you looked at what they've accomplished, even though it kind of eluded me, this payroll protection program, they commissioned all of the individual banks that had a clue about SBA lending and made those people be part of the SBA in order to try to get some short-term cash to people who absolutely were going to need it. I will tell you that some banks were much better than others at this, and mine seemed to suck, but the fact is that would be unheard of in terms of processing anything through somebody like the SBA in less than about 12 weeks is ridiculous. And they worked through $350 billion in 10 days, ran out of cash, trying to get some more. So I think the nimbleness of the government, if it continues the way it's going, is actually getting better, not worse. And so the response time and regulations are kind of getting out of the way more than they are. And at the same time, people complain about the regulations that were taken away from people like the EPA. Yet you look at the conditions, and I'm not even talking about these past 3 weeks when nobody's driving and therefore we're creating less pollution. But if you look at all of the major indicators on something like pollution, we've made dramatic improvements in the past 3 years at the same time as reducing the regulations associated with it. So if I'm in charge, that trend continues. Depends on how the country votes, though.
All right. Thank you.
You're welcome. See you guys on Monday.